Hey there, welcome to Page Pal Picks. Discover a new bestseller every week. Warren Buffett is widely celebrated as one of the most successful investors in history. This video encapsulates the top 5 insights from The Snowball, Warren Buffett and the Business of Life by Alice Schroeder, offering a comprehensive overview of Buffett's life and investment philosophy. Takeaway number 1, the power of compounding income. Imagine there were two friends, Sam and Alex, who shared a common passion for investing. They both received an inheritance of $10,000 each and decided to invest in the stock market. Sam, known for his impatience, chose to cash out his dividends every quarter. On the other hand, Alex, who had read about the power of compounding income, decided to reinvest his dividends back into the stocks. Year 1, Sam invested $10,000 in a dividend-paying stock with a 5% annual dividend yield. At the end of the year, he received $500 in dividends and cashed them out. Alex also invested $10,000 in a similar stock with a 5% dividend yield. However, he chose to reinvest the $500 dividends back into the same stock. Year 2, Sam maintained his initial investment of $10,000, and again, he received $500 in dividends, cashing them out. Alex, however, saw his investment grow to $10,525, initial investment plus reinvested dividends. With a 5% dividend yield, he received $526.25 in dividends. He decided to reinvest this amount as well. Year 3, Sam's investment remained stagnant at $10,000, and his dividends stayed at $500. Alex's investment grew to $11,051.25, initial investment plus 2 rounds of reinvested dividends. His dividends, now at a 5% yield, amounted to $552.56. Once again, he reinvested the dividends. As the years passed, the gap between Sam and Alex continued to widen. Alex's decision to reinvest dividends allowed his investment to compound over time. After 10 years, Sam's initial $10,000 remained the same, and he received $500 in dividends every year. Alex's investment had grown to over $16,386.62, and he was now earning around $819.33 in dividends annually. The compounding effect had significantly multiplied his returns. Alex, with his patient approach and understanding of the power of compounding income, not only watched his wealth grow but also enjoyed a substantial and increasing stream of passive income. Sam, although initially content with immediate cash, soon realized the incredible benefits he had missed by not harnessing the power of compounding. The story teaches us that, in the world of investing, patience, and the wisdom to let income compound, can lead to a truly magical financial journey. This principle resonated with Warren Buffett from an early age when he encountered a book titled 1,000 Ways to Make $1,000. Intrigued by a business idea in the book involving purchasing weighing machines and earning fees each time someone used them, Buffett grasped the essence of compounding income. Instead of weighing machines, he initially applied this approach to pinball machines. Recognizing the power of compounding, Buffett implemented it in forming his first investing partnership, Buffett Associates. The terms were unique. He would enjoy half the upside beyond a 4% gain but shoulder a quarter of the downside to his partners. This calculated risk significantly accelerated his compounding. Transforming Berkshire Hathaway into an insurance company, Buffett strategically harnessed the power of compounding over the years. Insurance premiums are collected before any potential claims, allowing him ample time to compound the money before payouts. Buffett's perspective on money further illustrates the point. While the average billionaire might disregard a dropped dollar as not worth the effort, Buffett sees it as the beginning of his next billion. This exemplifies the profound impact of compounding, a principle Buffett has masterfully employed throughout his career. 2. Be very skeptical of new paradigms. Embracing a new paradigm is akin to searching for a concept as elusive as new forms of intimacy in 1999, just before the dot-com bubble burst, as people fervently discussed the stock market's revolutionary shifts. Amid the hype, many anticipated consistent annual returns of 20%, questioning the wisdom of skeptics like Buffett who refrained from investing in the soaring internet stocks. Buffett, maintaining his trademark skepticism, outlined 3 scenarios justifying such lofty valuations. Low or decreasing interest rates. A rising share of the economy is allocated to investors, with diminished portions for employees and the government. Accelerated economic growth. However, he dismissed these possibilities as wishful thinking given the prevailing circumstances. Buffett emphasized the market's short-term voting mechanism versus its long-term weighing attributes. Contrary to voting, there is no literacy test for investing, a fact repeatedly demonstrated by the market. Nonetheless, in the long run, the weight of economic fundamentals prevails. Buffett illustrated this by highlighting the period between 1964 and 1981, during which the Dow Jones Industrial Average stagnated while the economy quintupled. Investors, believing in a paradigm shift, paid the same price for assets generating 5 times less. The lesson learned: herd mentality often obscures skepticism during bubble-like valuations. Navigating such environments requires adherence to an inner scorecard rather than an outer scorecard. Buffett suggested considering a scenario: would you prefer being the world's greatest lover, perceived as the worst, or vice versa? If choosing the former, you operate by an inner scorecard, essential for resisting the market's occasional irrationality. In times of exuberant valuations, maintaining an internal compass grounded in rationality becomes the key to avoiding participation in market madness. 3. Stay within your circle of competence. In a tale, a man managed to dominate the market for shoe buttons, a niche and relatively small market, yet he controlled it entirely. Once accomplished, he began envisioning himself as an expert in virtually everything, always asserting his knowledge among friends on various subjects like relationships, lovemaking, health, and more. Warren Buffett and his close associate Charlie Munger labeled this phenomenon as the shoe button complex. Buffett, a key figure in the financial world, attributes much of his success to steering clear of this complex. Instead, he adhered to his circle of competence, focusing on money, business, and his own life. Despite having the option to pursue his grandfather's dream of becoming an author, Buffett opted not to do so, a decision he considers fortunate. This principle is especially crucial in the realm of investing. Buffett emphasized the importance of avoiding businesses heavily reliant on technology beyond one's understanding. He stressed that investing involves understanding the business rather than just the stock. For instance, he admitted his limited knowledge about semiconductors or integrated circuits, comparing it to his ignorance of the mating habits of the crustacea. Buffett's advice revolves around remembering that investing is in a business, not just a stock. He encourages investors to comprehend the type of company they are buying. This may involve aligning investments with one's educational background, such as medical students focusing on healthcare and pharma stocks, or electrical engineers concentrating on the energy sector. Additionally, investors may consider putting more money into their domestic market or companies exposed to it, leveraging their understanding of the local business environment. For example, Buffett personally prioritizes the media market in his investment approach. 4. Use a margin of safety. Imagine being a construction engineer tasked with building a complex bridge, especially when it comes to calculating its carrying capacity. Knowing that trucks passing the bridge might weigh up to 40 tons, the crucial decision arises: do you design the bridge to support exactly 40 tons, or do you opt for a higher capacity, say, 60 tons? Choosing the latter might seem like a safer bet, given the uncertainties involved. Suppose you aimed for a carrying capacity of 41 tons. In this scenario, a small miscalculation could result in the bridge supporting only 38 tons in reality. Now imagine a heavy truck attempting to cross it, quite a precarious situation. While the risk remains, it is somewhat reduced compared to designing for the exact weight. Applying this analogy to the world of stock investing, it becomes evident that predicting the future of a stock is challenging and often prone to errors. Hence, the need for a substantial margin of safety. If you believe a stock is worth $50, the prudent move is not to purchase it at the same market price but to wait for a lower price, say $40, ensuring a margin of safety. Warren Buffett, influenced by his mentors Benjamin Graham and David Dodd, grasped the importance of a margin of safety early in his career. A crucial aspect of this approach involves investing in stocks that offer a buffer against errors. Buffett, during his early career, favored a specific category of stocks known as cigar butts, companies that are cheap and unloved, resembling a discarded cigar but still good for one more puff. This strategy involves seeking companies whose assets, if sold, would be worth more than the current stock price, essentially making the operating business a free component. Buffett never abandoned this margin of safety approach, enabling him to navigate speculative market bubbles successfully. When suitable investment opportunities were scarce, he remained in cash, avoiding the herd mentality that often leads to the pitfalls of a bull market's peak. 5. Invest where there is a toll bridge. Buffett's early mentor, Graham, instilled in him the principles of a true value investor, emphasizing the importance of focusing on inexpensive and unpopular stocks. However, in 1959, when Buffett crossed paths with Charlie Munger, his investment philosophy underwent a partial transformation. Munger brought attention to the significance of a company's competitive advantage over time. The concept of a toll bridge resonated with Buffett and Munger. The essence lies in the idea that once the initial investment, such as building the bridge, is made, the tolls can be increased in a monopoly-like fashion. This is possible because there is no alternative simple solution for customers to reach the other side of the bridge. In fact, at one point, Buffett and Munger jointly owned 24% of a bridge connecting Detroit and Windsor. Such investments act as proverbial toll bridges, providing a reliable income stream that could withstand isolation on a deserted island. Buffett encapsulated this approach with his famous quote, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Examining examples of toll bridges illustrates various forms. Brands. Coca-Cola's brand secures profits for years to come. Even if a competitor were to create a better soft drink, the immense advertising investment required would pose a significant barrier. Network effects. Social media platforms like YouTube and Facebook gain value as more users join. The stickiness of such platforms increases, preventing new entrants from delivering the same value and hindering their growth. Stickiness. Companies with high switching costs, like enterprise software company SAP, tend to be solid investments. Customers, faced with substantial effort and cost in transitioning to a competitor's product, are likely to stick with the original. High setup costs. Industries with substantial setup costs, such as railroads and electrical grids, discourage competitors. The stakes are exceptionally high, making it a challenging game for newcomers. Buffett's strategic acumen shines through these examples, showcasing the value of investing in companies with enduring competitive advantages. He encourages others to follow his advice, providing a pathway for aspiring investors to achieve greatness. If you found these insights valuable, let me know in the comments below, and don't forget to hit that like button and subscribe for more content.